Investing is an essential part of building long-term wealth. It allows your money to grow over time and outpace inflation. However, investing also comes with inherent risks. It's crucial to understand these risks before you put your hard-earned money on the line. Many people are drawn to investing because of the potential for high returns. They see stories of others making significant profits in the stock market or real estate. While these stories can be inspiring, it's important to remember that every investment carries a degree of risk. There is no such thing as a guaranteed return in investing. Stock prices can go down as well as up, and even experienced investors can lose money. It's essential to approach investing with a realistic mindset and understand that there are no shortcuts to financial success. Before making any investment, it's crucial to carefully consider your financial goals, risk tolerance, and time horizon. Are you investing for retirement, a down payment on a house, or your child's education? Each goal has a different time horizon and requires a different investment strategy. Market volatility is one of the most significant risks investors face. It can be both a source of opportunity and a cause of anxiety. It refers to the fluctuations in asset prices, particularly in the stock market. These fluctuations can be influenced by various factors, making the market unpredictable. Stock prices can rise and fall rapidly and unpredictably, driven by a myriad of factors. These include economic indicators, corporate performance, and global events. Economic news, political events, and even investor sentiment can all impact stock prices. For instance, a change in government policy or an unexpected geopolitical event can cause significant market movements. For example, a positive earnings report from a major company can send its stock price soaring. Investors often react quickly to such news, driving up demand and prices. Conversely, news of an economic recession can cause a widespread market decline. Fear and uncertainty can lead to a sell-off, pushing prices down. Market volatility can be unsettling for investors, especially those new to investing. The rapid changes can create a sense of panic and lead to hasty decisions. It's essential to remember that short-term fluctuations are normal and should not dictate your investment decisions. A well-thought-out strategy can help navigate these turbulent times. Long-term investors should focus on the overall trajectory of the market rather than day-to-day price swings. Historically, the market has shown a tendency to recover and grow over time. One of the most significant market downturns in recent history was the 2008 financial crisis. This event serves as a stark reminder of the potential severity of market volatility. Triggered by a collapse in the subprime mortgage market, the crisis led to a sharp decline in stock prices worldwide. The ripple effects were felt across various sectors and economies. Many investors who panicked and sold their holdings at the bottom of the market lost a significant portion of their savings. Staying calm and sticking to a long-term plan is crucial during such times. Emotional investing is one of the biggest pitfalls for investors. Fear and greed can cloud judgment and lead to poor investment decisions. When markets are soaring, it's easy to get caught up in the excitement and make impulsive buys. Conversely, when markets are plummeting, fear can set in, causing investors to sell their holdings at a loss. It's essential to remember that investing should be a rational process based on your financial goals and risk tolerance, not your emotions. One way to avoid emotional investing is to create a well-defined investment plan and stick to it. Your plan should outline your investment goals, risk tolerance, and time horizon. It should also include a strategy for rebalancing your portfolio periodically. Another helpful tip is to avoid checking your portfolio too frequently. Constantly monitoring market fluctuations can amplify your emotional responses. Remember that investing is a long-term game and short-term volatility is normal. Section 4, Diversification. Don't put all your eggs in one basket. Diversification is a fundamental principle of investing. It is a strategy that can help you manage risk and protect your investments from market volatility. It involves spreading your investments across a variety of asset classes to reduce risk. This means not putting all your money into one type of investment. By diversifying, you avoid putting all your eggs in one basket, so to speak. This way, if one investment performs poorly, others may perform better and balance out the overall performance. Different asset classes tend to perform differently in various market conditions. This means that while one asset class may be down, another could be up. For example, when stocks are performing well, bonds may lag and vice versa. This inverse relationship can help stabilize your portfolio. By diversifying across asset classes, you can potentially smooth out your returns over time. This can lead to a more stable and predictable investment experience. There are many different asset classes to consider when diversifying your portfolio. Each has its own risk and return characteristics. Stocks, bonds, and real estate are some of the most common, but there are also other options like commodities, mutual funds, and ETFs. Within each asset class, there are also subcategories. These subcategories allow for even more diversification. For example, you can invest in large-cap stocks, small-cap stocks, or international stocks. Each of these has different risk and return profiles. The level of diversification that's right for you will depend on your individual circumstances. Your financial goals and personal situation will guide your choices. Factors such as your age, risk tolerance, and time horizon will all play a role. Younger investors might have a higher risk tolerance compared to older investors. As a general rule, younger investors with a longer time horizon can afford to take on more risk and may choose to allocate a larger portion of their portfolio to stocks. This is because they have more time to recover from potential losses. On the other hand, older investors nearing retirement may prefer a more conservative approach, focusing on preserving capital and generating income. Ultimately, diversification is about finding the right balance for your unique situation. It's a key strategy to help you achieve your financial goals while managing risk effectively. Section 5. Beware of investment scams. If it sounds too good to be true, it probably is. This age-old adage holds especially true in the world of investments. Investment scams are unfortunately common, and it's essential to be aware of the tactics scammers use to defraud investors. These scams can take many forms, from Ponzi schemes to high-pressure sales tactics, and they often target those who are looking for quick and easy profits. Scammers often prey on people's desire for quick and easy profits, promising unrealistic returns with little to no risk. They know that the allure of making a lot of money with minimal effort can be very tempting. One common type of investment scam is a Ponzi scheme, named after Charles Ponzi, who orchestrated one of the most famous schemes in the early 20th century. These scams continue to deceive people to this day. In a Ponzi scheme, the scammer uses money from new investors to pay returns to earlier investors, creating the illusion of a profitable investment. This cycle can continue for a while, but it is inherently unsustainable. However, the scheme eventually collapses when there are not enough new investors to sustain the payments. When this happens, many investors lose their money, often with little recourse. Another red flag to watch out for is high-pressure sales tactics. Scammers often use these tactics to create a sense of urgency, making you feel like you need to act immediately. If someone is pressuring you to invest quickly or threatening you with missed opportunities, be wary. High-pressure tactics are a common sign of a scam. Legitimate investment professionals will give you time to research the investment and make an informed decision. They understand that making a sound investment choice requires careful consideration and due diligence. If you're ever unsure about an investment opportunity, don't hesitate to seek a second opinion from a trusted financial advisor or a friend or family member with financial expertise. Getting a second opinion can provide valuable insights and help you avoid potential scams. Remember, it's always better to be safe than sorry when it comes to your money. Taking the time to thoroughly vet an investment opportunity can save you from significant financial loss and stress in the long run.